Chinese equities have fallen 16% from the highs of February 18th to the lows of March 8th. And all of that whilst the Chinese economy has been lauded around the world as the best performer during the COVID-19 pandemic. So this raises the question, is there a buying opportunity in Chinese stocks? In short, the answer is yes. And here are 3 reasons why Chinese stocks will likely recover in coming months. The first reason is the economy. Last year, China was the only major economy to register any economic growth. It turned in 2.3% GDP growth in a year when the United States economy contracted 3.5%. The euro area shrank 6.8%, and Japan's GDP declined 4.8%. And it gets better in 2021, when the IMF expects China to grow by 8.1%, outperforming the United States 5.1%, the euro area's 4.2%, and Japan's 3.1%. And with that economic growth comes corporate earnings growth, a stunning 37% surge in the index earnings of the CSI 300 is predicted for this year. The second reason is valuation. China's CSI 300 index is now trading on a forward PE ratio of 14 times its 2021 earnings. The S&P 500, by comparison, is trading on 23 times its 2021 earnings. And given how they both have roughly the same earnings per share growth rate for the current year, the PEG, or the PE to growth ratio, is even more attractive for China than in the US. 0.38 times for the CSI 300 versus 0.57 times for the S&P 500. The third reason is Chinese policymakers have conserved a lot of ammunition to stimulate the economy again if they need to. That's not the case in the US, where policymakers have hit 0 interest rates, 0 reserve requirements, and monetary expansion so rapid the US dollar index had declined 13% from its March 2020 high to its January 2021 low. With rates that low and money supply overflowing, what do US policymakers do for an encore performance if markets collapse? Compare that with the People's Bank of China's cash rate of 2%, its reserve requirement ratio of 9.4%, and more conservative money supply expansion, which has seen the CNY, the Chinese yuan, rise 12% against the US dollar between May of last year and January of this year. That's a lot of stimulus conserved right there that can be released if needed. Do not underestimate this last factor. The market may hate this policy conservatism now, but it may really appreciate it sometime in the future when the economy really needs that stimulus. And this seems to be one of the reasons why legendary fund manager Ray Dalio recently said he believed Chinese assets would outperform assets from mature developed markets. Have a look at this chart of the inflows into Chinese government bonds last year. It seems a lot of international investors agree with Ray Dalio. To be clear, there is pain in the Chinese market right now, but the fundamentals are looking good for those with a longer time frame.